Western Union is a very untypical business. It's not really a bank where you go to open an account, get a credit card, get a debit card, save money, maybe even invest where. No. This is a company that you use to send money out of your country, and it's mainly used to send money to your home country. So the main customer here is immigrants who left their country to work somewhere where they can earn more money, provide for their family at home. And now you think, company at a 5 PE, 8% dividend, buying back shares like crazy. I mean, 8% right now, that seems kinda insane. In total, we have 16% shareholder returns. First, we're gonna see, how does Western Union operate? It has two segments. One, money transfers. This is where most of our revenue comes from. And now, how is that working? Well, minus 8% adjusted revenue growth. I don't know how you can say adjusted revenue, to be honest. They're trying to talk it nice by like saying, oh, if we exclude Iraq, for example, we had 1% revenue growth, but it doesn't bring anything. If one of your markets performs poorly, you can't just say, hey, without this market, we would have performed well. Revenue went away. Well, honestly, this was only 87 million in revenues. You have 1 billion in total. If this going away impacts your business so heavily, then that is not good. This is basically a no-growth business. This business is very competitive. When it comes to money transfers, Western Union used to have a monopoly there. There was no other way to get money home. Banks didn't really offer that much, and if you send money back home, it was with huge fees. Western Union kind of fixed that. If you don't know how it works, let's say you're an Indian worker living in Singapore, you go to a store that is either owned by Western Union, or it's just a corner store which have a Western Union partnership. They handle the transaction, and they get a little cut. You go in there, say, hey, I want to send these $100 back home to India. Okay, that's gonna cost you 5%, and then the person can withdraw that at a store in India. And that used to be very profitable because no one else was doing it, but now because everyone in the world is getting internet, even if you live in a mud hut in the middle of bum nowhere, you can have a digital account, and this is how you can get money easily. In this case, even crypto is disrupting you. This is one of a few business segments where I would say crypto actually has a use case. Stablecoins can be used to send money anywhere. So this business is heavily getting disrupted. How does the other segment look like? Customer services, with stuff like money orders, exchanging money. This is not getting disrupted as hard. You can't really do forex exchange digital. You need to have those in-person stores. Prepaid cards, well, that's a bank. But this is also where a lot of competition lies. Yes, they had some good revenue growth here, but it's a small part of a business and it's also very competitive. 90% of their money comes from the consumer money transfer services. It used to be 93%, so you can see that this business is growing faster, well, than the one that is declining. Not really hard. This is where the cash comes from. If this thing is in trouble, no share buybacks, no dividends. Now they make a lot of cash. This is a very great business. You have high margins, very low risk. Cash flow, 272 million. CapEx, 92 million. So around 180 million in free cash flow. Dividends, 239 million. Not really covered by the cash flow. Plus for share repurchases. So we can see they're taking on debt. Now that is mostly because of a tax settlement they had with IRS. They had to pay a way higher tax here, 403 million. Now it would be more in the 500 million range. If you look at it, they reduced net debt after the pandemic. And since then it has been kind of stable, up and down here and there, but overall, mostly stable. And then I see, okay, this is a business giving you an 8% dividend, offering 8% buybacks. However, it is getting disrupted. And buybacks are worthless if a business is going to zero. Dividends you have in your pocket. Buybacks, it doesn't matter if you own 100% of a bankrupt business or 50%. The business is bankrupt, it's worthless. So, this is a very risky stock. If the business manages to stabilize and the competition doesn't destroy you, then this could rally hard. I mean, only in 2021 it was already getting disrupted and they're trading at $25. Now it's at 10. Now, of course, since 2021, revenues have heavily declined, but that has happened before. So this is a difficult stock. And I would personally put it in the too hard pile. I do not know if this business can stay. Now, in the meantime, your risk is heavily reduced because you get that 8% dividend. And the cash flow is going to be there for some time. It's not going to go away on day one, but it's probably getting chipped away slowly. If they don't manage to stabilize it, and maybe you're going to sell with a 50% loss in a few years, at least you got a dividend. That kind of lowers your risk here. You can't just only look at this from a reward perspective, like 16% free cash flow yield basically, great buybacks, this company is great at returning money to shareholders. You also need to look at the risk here. The risk is that you only get this 8% dividend, stock declines to maybe $5. It doesn't matter how many buybacks they do, they're gonna go bankrupt eventually, maybe. So this is all just hypothetics you have to consider. Now, if I manage to stabilize this, I don't know at what level it would be, then that would be great. Let's look at the numbers. What would happen under what scenario? Now we have to see, where are we gonna say free cash flow is gonna level off at? I would say we should go with 550 million for now. This is kind of where they've averaged with a slight decline. Yes, they had their great years, but the business has declined since then. Now, what are we gonna assume the growth rates to be? But just so you know, they're not gonna be buying 8% of the shares as they're doing it right now. That is an outlier. Usually they are buying around 5 to 3%. During the times where they were deleveraging, they bought back way less. But let's go with around 4%. With a disrupting business, let's be conservative, let's say they're also going to decline by around 3 to 4%. So when it comes to the free cash flow per share, that stays kind of even. Now, 60% payout ratio with a little reduction due to taxes, that at an 8 multiple, it is just not a great company. It doesn't grow, and I think 8 might be a bit too high. But let's just stay with this for now. That would give us around $10 per share. So you would make around 10%. But this is a fairly risky stock, so I would want a higher margin of safety there. Because now what if it goes worse? Let's say the company declines even further, or they're not going to be able to buy back as many shares. This would be a fairly heavy disruption if they can't keep up with the share buybacks, but you have to consider that. 3% for the next 5 years, 4% afterwards, 5 multiple, $6.8 per share. Now what if it goes good? What if a company turns around? They're going to stabilize their revenue and they are going to be able to buy back the shares. 4% growth, so basically no revenue growth and the share buybacks. 12 multiple because now the company is surviving. If it's not in decline, it's not going to be as heavily discounted. Yes, then the stock has a nearly 2x potential. But I'm going to keep my hands off Western Union. This is a very low quality company, which I wouldn't want to have in my portfolio. Its main business is getting disrupted heavily. Yes, they have consumer services, which do not have such a great margin as the money transfers though. Plus, there's also a lot of competition there, so I'm not gonna touch it. Maybe if it goes to ridiculous, like, I don't know, $2 to $3, I'm definitely gonna add it. I don't really see me buying the stock right now, unless I see clear signs of a management somehow turning this around. What do you think? Write down below. Have a good day.